In a recent video, we noted how the problems in China's real estate market are starting to hit U.S. markets directly through property developer Oceanwide and its development projects in U.S. metro areas. Today, we're going to take a look at the data and see if there's anything we need to worry about in the U.S. commercial real estate market as a result of Oceanwide's problems. Let's get into it. Oceanwide Holdings, a Chinese property developer operating in the U.S., ran into a bit of trouble back in October as creditors seized their San Francisco development project after failing to make payment on corporate debt issued by two of its offshore units. The project seized was the San Francisco Oceanwide Center, a two-tower, 2 million square feet project that was started at Mission and First Streets. Oceanwide has made some attempts at raising cash to dig itself out of their financial hole they're in, including the reported sale of International Data Group to Blackstone and trying to sell their project in Manhattan at a big discount. Such is the fate of Chinese property developers these days, in a crisis that was brought to international attention as the developer China Evergrande was warning about defaults back in September. Oceanwide Holdings is sadly another name on an ever-growing list of Chinese property developers that seem to have taken on more debt than they were able to repay. And now the bill has come due for many of them. Investors around the world are keeping a close eye on developments as the stakes are high. A collapse in the Chinese real estate market could lead to a significant downturn in the Chinese economy, given its substantial share of the country's GDP, which would have ramifications on the global economy as well. In our last video on the topic, we took a look at how a significant downturn in the Chinese economy could hit the U.S. economy, not just the real estate market. If you're watching this on our Real Estate Watch channel, you can find that video on our main channel, PapayaCast, where we cover more than just the real estate market and we look at some of the bigger macro trends in the U.S. economy overall. I'll also leave a link to that video in the description down below. Today, we're going to take a look at the most recent commercial real estate data, looking specifically at the office property market to see what the potential fallout of a collapse in Oceanwide Holdings could bring given their projects here in the U.S. According to CBRE, a commercial real estate service and investment company, the vacancy rate in the San Francisco metro area, where Oceanwide's project was seized as collateral, was 18% as of the third quarter of 2021, much higher than the pre-pandemic low of 4.6% in the fourth quarter of 2019. Like many other major cities across the world, office vacancies surged after stay-at-home orders were implemented in 2020. The most recent vacancy rate is down slightly from the previous quarter, and it seems like we've reached a turning point and begun recovering for the office market in San Francisco. Not surprisingly, rents plummeted as vacancies rose last year, and this is just basic economics at work. Demand for office property tanked once people started working from home, and available supply rose as a result. Let's check out two other markets where Oceanwide has projects, New York and Los Angeles, and see if we're seeing anything different in those office markets. Here's New York office vacancy and rents looking very much like the San Francisco market trends, with vacancy rates surging and rents plummeting at the onset of the pandemic. And just to note, this isn't a trend for these markets alone. We see it in the overall U.S. market statistics as well. Los Angeles, however, seems to have bucked that trend and defied basic economic theory. While vacancy rates rose like other places, rents actually continued to trend higher, seeming to contradict that basic economic relationship of supply and demand noted earlier. I went a bit deeper into the data to see what was going on, looking at downtown and suburban submarkets separately. For the Los Angeles downtown market, we see the rapid rise in vacancy rates at the onset of the pandemic, but notice how it was more or less returning to the higher vacancy rates this market was experiencing just a few years ago. This is likely what prevented downtown rents from plummeting, as elevated vacancy rates were in the recent memory of property managers and those looking to rent. As rates continued rising, we did see a slight downward trend in the trajectory, but rents more or less leveled off rather than dropping significantly. This would have given some support to overall market average rents we saw in the larger metropolitan area average. And then looking at the Los Angeles suburban market, we see an upward trend in rents even though vacancies were rising, and this is what is pushing the rents higher in the overall market average. While it seems contradictory at first glance, notice what was happening right before the pandemic. Vacancy rates were on a steady downtrend that accelerated just before the pandemic, which pushed rents sharply higher and signaling a very strong demand in this market. Once vacancy rates started surging during the pandemic, we saw rents leveling off and then staying within a range of $45 to $47 per square foot. So nothing too crazy going on in this Los Angeles market once we dig into the submarket data a bit more. Downtown rents weren't hit as hard because the area already had high vacancy rates in recent memory, and the suburban market had the momentum of previous demand, helping to prop up rent even though vacancy rates were rising. So overall, what we're seeing in markets where Oceanwide has development projects is higher vacancy rates, primarily as a result of the shift of many office employees working from home, which is a nationwide trend. For our analysis, this is actually a good thing in that it would insulate U.S. office markets from a collapse of Oceanwide or any other property developer, just because there's so much extra supply right now. If a developer's office project didn't go through, that would actually help U.S. office markets, as it would not add to the existing supply and push further downward pressure on rents. Given all the doom and gloom in the news lately, and unfortunately a lot of our videos lately, it's nice to be able to conclude nothing to worry about here. We'll be continuing to look at all angles of how a Chinese real estate collapse could hit U.S. markets, so make sure you're subscribed and hit that notification bell down below so you'll know right away when our next video comes out. If you're watching this on our Real Estate Watch channel, don't forget to keep an eye on our main channel, PapayaCast, where we'll be tracking how a Chinese economic downturn would affect the U.S. economy outside of the real estate markets. We also post all of our real estate content on the main channel, so you won't miss anything if you're just subscribed there. And if you found this information useful, please give this video a thumbs up to support the channel and help us grow. Thanks for stopping by, and I'll see you in the next video.